When a coordinated strike hits Middle Eastern energy infrastructure, the market's first reaction is to calculate shipping delays, but shipping lanes can be cleared. What we are looking at here is severe physical destruction to heavy industrial capacity. The global energy market is currently facing a structural deficit of up to 22 million barrels per day. That figure is more than triple the magnitude of the 1973 oil embargo. While spot prices capture headlines, the underlying destruction of physical assets arms a hidden time bomb within domestic private credit markets. Investors pricing this as a temporary logistics hurdle are missing a massive vulnerability. They are overlooking exactly how a physical supply shock cascades into a $3 trillion financial crisis. This flowchart maps the contagion. We can trace the direct causal link from physical commodities to entirely uncorrelated digital assets through 3 distinct nodes. First, the destruction creates a rigid lag in physical supply. Heavy industrial facilities cannot be rebuilt overnight. Second, that physical shortage forces global central banks into a strict monetary paralysis, commonly known as a stagflation trap. Finally, those frozen interest rates exert crushing pressure on highly leveraged private markets, identifying where the first institutional defaults will surface. Historical supply shocks leave permanent economic scars. The 1973 embargo locked the global economy into years of depressed growth and elevated consumer panic. Today, the damage extends beyond the refineries. When export lanes are blocked and storage fills up, operators are forced into what the industry calls shut-in damage. Halting production at active upstream wells severely degrades the physical reservoirs, permanently reducing future output even after shipping resumes. This timeline matrix outlines the reality of repairing custom, heavy industrial equipment. While a minor pipeline breach takes weeks to fix, replacing destroyed core distillation towers requires a strict 6 to 18-month cycle of fabrication and installation. To bridge this gap, the International Energy Agency authorized releasing 400 million barrels from the Strategic Petroleum Reserve, or SPR, which is a stockpile of crude oil maintained for emergency use. But the math simply fails. A 400 million barrel reserve being drained to plug a 20 million barrel daily deficit exhausts itself in less than a month. The SPR will run completely dry months before the earliest refinery repairs are completed. This math is even worse for liquefied natural gas, or LNG. Unlike crude oil, there is no strategic reserve buffer for LNG anywhere on the planet. Because no amount of stored reserves can fabricate heavy machinery faster, the global economy is mathematically locked into a prolonged structural energy deficit. That overseas deficit transmits directly to Washington, bleeding straight into domestic inflation metrics. Record-high domestic shale production prevents a total collapse of U.S. GDP. However, because energy trades on a global market, imported price shocks still push the U.S. Consumer Price Index up toward 4.5%. This creates a textbook stagflation trap, a destructive collision of war-driven commodity inflation, happening at the exact same time the domestic labor market is rapidly cooling off. Facing this trap, the Federal Reserve is forced to abandon any planned rate cuts. They must freeze the federal funds rate in the high 3s indefinitely to fight the inflation, despite the pain it causes workers. The bond market instantly digests this reality. Investors recognize that yields will remain elevated well through 2026, regardless of how much the domestic economy slows down. By keeping rates high to fight an oil shock they cannot control, the Fed effectively imports the Middle Eastern infrastructure crisis and bakes it straight into the foundational cost of capital for every business in America. Across the Pacific, the impact is even more acute. Japan relies almost entirely on imported energy, making its economy highly sensitive to this supply shock. When crude oil prices surge in US dollars, the Japanese yen collapses under the weight of those import costs, rapidly accelerating toward the critical threshold of 160 to the dollar. The Bank of Japan faces 2 failing options. Option 1 is hiking interest rates to defend the currency. But raising borrowing costs would instantly suffocate Japan's already stagnant domestic growth. More dangerously, hiking rates would devalue the bank's massive holdings of JGBs. JGBs are Japanese government bonds, the primary debt instruments issued by the state, and a severe drop in their value threatens the solvency of domestic financial institutions. Option 2 is refusing to hike rates. This allows import inflation to spiral completely out of control, eroding the purchasing power of Japanese households. This strict policy paralysis risks triggering a massive unwinding of the yen carry trade, a scenario where investors rapidly pull capital out of global markets to cover domestic losses, sucking liquidity out of the system right when it is needed most. This global liquidity drain and elevated interest rate environment lands squarely on a $3 trillion sector, the highly opaque private credit and BDC market. BDCs are business development companies, specialized firms that lend directly to private businesses. Within this shadow banking system, the most overexposed asset class is software. Between 2015 and 2025, private equity firms executed buyouts on roughly 1,900 SaaS companies. SaaS stands for Software as a Service, a business model where software is licensed on a subscription basis. These software buyouts were engineered using cheap, floating-rate debt. When the Federal Reserve locks interest rates higher for longer, the debt servicing costs for these companies skyrocket, devastating their cash flow. This diagram shows a simplified balance sheet for one of these buyouts. To prevent immediate defaults, private equity firms activate an emergency survival mechanism known as PIK debt. PIK stands for Payment in Kind, a debt structure that allows borrowers to defer cash interest payments. PIK allows struggling borrowers to forego their monthly cash interest obligations. Instead, the lender simply adds that owed interest directly onto the principal loan amount. In a high-rate environment, PIK triggers a toxic compounding effect. Over just 3 years, a company burning principal to cover its interest can watch its total debt burden balloon by nearly 26%. This artificially bloated debt is on a collision course with the 2026 to 2027 maturity wall. This is the exact window when billions of dollars in short-term BDC debt suddenly comes due and requires refinancing. An oil refinery explodes in the Middle East, constraining physical supply. That supply limit forces the Fed to hold rates high, which mathematically prevents U.S. software companies from refinancing their bloated PIK debt. That is the transmission chain we are tracking. This private credit crisis lacks the specific triggers necessary to cause a 2008-style banking collapse. Following the 2008 crash, regulators implemented strict Basel III capital requirements. These rules successfully insulated the major, systemically important banks from direct exposure to this type of highly leveraged shadow debt. The damage remains trapped entirely within the opaque shadow banking system, creating a persistent, chronic bleed of capital. The ultimate bag holders are not retail depositors, but pension funds, sovereign wealth funds, and university endowments. They face years of trapped capital and non-existent cash distributions. A shadow banking crisis is highly insidious because it hides catastrophic losses from the public eye. Managers simply report artificially inflated NAVs, or net asset value, which is the estimated total value of the fund's underlying investments, delaying the realization of those losses for years. This high-rate trap is simultaneously fracturing other collateralized sectors, driving a record surge in defaults across subprime auto ABS. ABS stands for Asset-Backed Securities, which are financial instruments tied to underlying consumer loans. Historically, during prolonged inflationary conflicts, hard assets like physical gold severely outperform fiat currencies like the US dollar. Institutional investors treat gold as a mathematical flight to safety when fiat central banks lose control of the yield curve. Central banks possess the infinite power to print liquidity and manipulate digital ledgers, but they cannot print a functioning oil refinery. When the system breaks, physical reality remains the ultimate limit on financial engineering.